Thanks so much, and good morning, everyone. Seems strange not to be speaking with a microphone like you, but actually not having any projection. I don't know all of your backgrounds, but I suspect there's a vested interest across the board. It's underlying property. It's how can we capitalise our hard-earned money and make some more from it. So I'm just going to give you a brief overview of what we're seeing in the commercial property auction market. Have you got a clicker? Oh, you're the driver of it.
It's working, but it's not, so I'll click through.
So this is me. I'm sorry for the big picture. A bit of background. I've been at Allsop for 13 and a half years, qualified off the graduate scheme. Been in commercial auctions for about 12 and a half years or so, or 11 and a half years. I did have a stint on the rostrum from December 2015, but COVID curtailed that in February 2020. We now operate purely online at the moment, obviously always assessing ways that we may wish to, how we're going to do it, go back to some form of live event, but who knows, it's up in the air at the moment. In that time, I've seen quite a lot. We've sold over 9,000 lots and raised nearly £6 billion. So there's a lot of through flow in what we do. It's generally a high volume market, lowish value. Anything sub 5 million is probably what we do, but we do a lot of it. People refer to it really as the coalface of the investment market. And those of us that work in it would say it's because it's hot, dark, sweaty, uncomfortable, and at times pretty horrible. But it's actually where the action's happening. We're right at the coalface. It's the immediacy of the deals that we do. And we only have to look back to the auction we had just after the Brexit referendum vote back in June 16, was it? I can't even remember, it was that long ago. We were in the Park Lane Hotel in the gallery ballroom, and it was packed to the rafters. And most people were there just watching, so many agents seeing, is there still a market? We've just had, we're leaving. And as soon as the first 10 lots all sold, all the shoulders went down, all the agents went back to their desks and said, the market's fine, we'll carry on. So it's the coalface. Day to day, what do we do? It's full spectrum. It's private individuals, private investors, property companies, propcos, corporates, REITs, funds, institutions, advising on pricing, advising on strategy, and the best way for them to exit what they have. Often we'll advise if people are looking to buy portfolios, we'll advise on pricing for the way in because they're always going to work out some pretty quickly on the way out. So as a business, if we just go on to the next slide, sorry, that's what we're going to touch on, who we are as a business, what we saw last year, what we've seen so far this year, and then things to consider when we're looking ahead for the remainder of this year. Next one. There we go. So for those that don't know, Allsop's one of the last reasonable sized partnerships within the property consultancy world. As of last Friday, there are now 23 equity partners. Jimmy Bruce and our residential team got invited to the top table last Friday. About 250 people throughout the UK. We're head office on Wigmore Street, just in the West End, but we have a city office. Leeds, which is predominantly residential, but offers some commercial services. And we have an alliance with the Millennium Group out in Hong Kong and Singapore. Clearly, there's a lot of capital out there looking to be funneled into UK real estate, so we have some boots on the ground out there. The services we offer are down at the bottom here. I've highlighted auctions, not only because that's what we're going to talk about today, and that's what I do, but probably it's why the brand is best known, particularly amongst the private investors, is our residential auctions and our commercial auction teams, where we've been at the sort of forefront of the market for the last 3 or 4 decades. In terms of where we operate, it's everywhere. So we're not sector specific, we're not geographically focused, we're not too precious or too proud to touch the small things or too humble to go for the big things. We work throughout the country from Scotland right up to the north, Cornwall to the northeast of Scotland, and it gives us a breadth of knowledge. It gives us that ability to compare, as you will all do when you're looking for the next deal. It doesn't just have to be what's close to home, it's throughout the country. So it gives us that information. And I think if you just click the next one, over the last 5 years, we've sold a property in every borough of the UK, with the exception of the Orkneys and the Isles of Scilly. So with that comes information. We know who's buying, we know who's active, what pricing is doing. So I think it's just a good geographical picture of where we operate and where you might consider operating when you're going to be parking your cash. You don't just have to be focused on home. And I think having that breadth of availability of stock, but also the information that we get from this, can all help you going forwards. So it's not an individual-based thing. This is our team. There's 18 of us. It takes a lot of effort to bring together auction catalogues. We've got from the top right-hand corner, Patrick, who actually stepped down on Thursday last week after 47 years at the business. You might think he's quite old, but he's annoyingly young. Through to Ben and Charlie, who joined us off the graduate scheme in September last year. So it's a full spectrum of people, like a little orchestra. Everyone has their piece to do. Day to day, we generally do the same things, but we get out, we go and see every single property we sell. We need to see it. We need to know what it is, what's around it. So it requires a lot of hard work. Everyone has their good auctions, everyone has their bad auctions, but together we get through. So in terms of what we saw last year, and again, those are some high-level numbers. Statistics are boring. It's more about the stories behind it. So at 440 million or thereabouts and 660 sales, it's about 20% down on the year before, which I think isn't surprising given what we saw with rates through 2023. But it shows there's still liquidity in the private investor market. Most of our buyers are cash. They don't have investment committee behind them because they're big corporates. If the deal makes sense, they'll buy it if the price is right. So being 20% down against the larger market where the bigger assets that are hugely debt-driven, that market ground to a halt in the early part of the summer of last year across various sectors. Some have restarted, some really haven't. The general commercial market down about 50% last year. Our market at the smaller end, is certainly down a little bit, but it's still very active. I think that the disparity between sellers' aspirations and market expectations is also something that has hindered the volumes of stock. I think we're in a phase, or we certainly were last year, where sellers were looking in the rearview mirror at historic valuations that they might have had done 6 months, 9 months ago. And if something was worth £1 million to them then, on paper, and today the market is saying it might be worth 900, a lot of sellers are not under pressure. And so they're saying, I'm going to hold on to it. It's got to be worth £1 million. And some of the prices have held, but a lot of assets pricing has crept. So where there's this disparity in pricing, sellers have been holding on to their stock. So there is a shortage, shall we say, of correctly priced assets in the market. There are a lot of assets in the market that are incorrectly priced. And often we see those come back round to us 6 months, 9 months later, and they haven't had the success that they were hoping at big numbers. So buyers are looking forward saying, in 2 years' time, 3 years, 4 years, where is pricing going to be? I'm going to have to buy now at the price I want, whereas sellers are saying, I'm looking backwards, it was worth that. 50% of the sales we did last year were outside of the auction, either pre or post, still on the unconditional auction contract. Commonly, that was the bigger lots being sold prior, where the threat of it going to auction and someone losing it meant that they would put forward a strong bid beforehand, exchange unconditionally before the auction, deposit down, done, 4 weeks completion. A lot of those things, as I mentioned, that had been out on the market previously and come back round, or under offer and stalling and dragging, put an auction contract in front of someone, sign this, you've done all your work. If not, it's going in the auction. It's amazing the pressure of an auction can get people to perform. And then afterwards, where things don't sell, we're still doing a lot of sales afterwards. Sometimes people aren't quite ready in time. A lot of these sales are at the reserve price. There will be a little bit of flex from some sellers that want to move on, but occasionally we get above it and we have bidding wars post-auction, which seems ridiculous because someone could have bought it for less at the auction, but these things happen. Buyers are very comfortable buying big lots unconditionally on auction contracts. The vast majority of our stock is income producing. All of the work is done beforehand. The legal packs are available, as you well know. So buyers are very comfortable spending, last year up to about £5 million on an auction contract. 50 of those were at £2 million. And as I said earlier, the lot size last year ranged from 37,500 up to around 5 million. So it really is a plethora of what we offer, from some things that most of you wouldn't even touch, right through to the things that are hugely sought after. So it's a full spectrum of properties that are offered. In terms of buyers, what we saw, it's always been private investor-led, private property companies, no external shareholders, a lot of family, a lot of long-term property companies. Predominantly, it's domestic, as it's sort of had that appeal for a long time, but we have a lot of overseas buyers, South Africa, Middle East, Hong Kong, Singapore, Australia, that regularly crop up. And I can remember back in the auction room, A man flew over from Australia, landed that morning, turned up at an auction, bought a charity shop down in the southwest, got on a plane, flew back the next day. And his idea was he was going to donate it to the charity. So the reach of the auction market is vast. The ability to bid online now means that you can bid from anywhere. I sold something in Stoke, about £2.5 million, to a man that was lying on a beach in Morocco. So it's amazing who comes out of the woodwork. As I said, most people say they're cash. About 80% of our buyers say they're buying in cash. Many will go on to finance post-completion, roll into an existing facility, or finance to release equity to do the next one. Interestingly, 30% of every auction, when we gauge our buyers, tend to be new buyers. So that's encouraging. It shows there is appetite and sentiment to come into the market, which gives confidence to everyone else that's already in there. It probably proves that our marketing is working because we're finding new people that are coming in. The demand to buy, again, 94% is obviously hugely encouraging. The buyers are less opportunistic than they have been in the past. They're taking more of a longer term view. I think life in general has become so short term and so immediate. If you look at the political environment that we're in with chopping and changing, and yes, when the market is charging on, there is a quick buck to be made by turning things, buying well and trading them on. But actually now, with higher rates, buyers are having to take a slightly longer term view. So it's less opportunistic, and fewer buyers are buying in their patch. We used to see a huge amount of people set the geographical boundary and only buy within X number of miles of where they live or certain towns that they knew, probably because it makes management easier. They like to drive past and just keep an eye on it. They know the people on the ground that can help them. But now I think because of where pricing is, buyers are having to be more deal driven. They're going to have to go outside of their comfort zone, outside of their parameters to find the deal that gives them the return that they want. So the buyers are evolving continually, but underlying it is all private individuals, private investors, predominantly like you that are sitting here. In terms of selling, no surprises again, private investors and private property companies make up the bulk of it. All these other sellers, the assets they're selling, will no doubt be recycled at some point and fall into that bottom category of private. So it's a very recycling sort of market. We saw funds and institutions come into the market at the end of last year, and that's probably because valuations caught up with where the market was. No fund manager can sell below valuation, or they'll have to argue really hard to get it through committee. But as valuations, some done monthly, some done quarterly, caught up with the market, as there was a bit more evidence, it gave fund managers flexibility to actually move on the assets that are surplus to what they want. And generally for the larger entities, the more corporates, it was the smaller assets, the time-consuming, the high management assets, where it's sucking too much of their resource to manage. They probably shouldn't really be owning these things. And the upside of holding outweighs the immediate of having that cash in the bank, moving on, redeploying personnel elsewhere. Councils, unsurprisingly, came into our market throughout last year. Clearly, headlines of cash-strapped bust councils. We acted for, not saying these ones are bust, but we acted for Bournemouth Council, Milton Keynes Council, Bromley Council, and a few others. A package of ground rents down on the south coast. Bromley was mostly retail parades down in South East, which some of you may well have seen, and a couple for Milton Keynes. And it's amazing how many more we're in contact with at the moment. There's a high, or seems to be, a high turnover of personnel in some of these property departments of councils. And that probably means that often the extent of their portfolios aren't 100% known. There's always something new that someone discovers. And therefore the management at times hasn't perhaps been as good as it could be. So there's clearly a call for cash for councils. They've been selling off some real estate. The parades in Bromley, which Omar, you saw back in, I think it was February last year. Huge demand for them because it is the classic auction private investor buy, mixed use. Some of them were ground floor only, others had upstairs either with residential or the potential to convert. Retailers and operators, corporates that own real estate that decided they're not property companies. Their focus should be on putting money into the operating business, stabilising those, making them as profitable as they can, rather than having capital tied up in real estate. So we've sold, we'll come on to it, a lot for William Hill. We've done some medical, some vets, who else? Tesco's, Farm Foods, dentists, various other things. So sale and leaseback's always appealing, long leases generally, and a redeployment of capital from the more corporate owners into their operating business. There's a lot of numbers on here, I'm not going to go into all of it, but our market is predominantly retail. It always has been. About 60 to 70% of the commercial auction market would be tagged retail. Obviously, there are little subdivisions of that. It's because the private buyers always understood it. Yes, you can look at their accounts online, but you can walk into a shop and speak to the person on the ground. How's business? It's amazing how many people will actually tell you a lot of information. When we go on inspections, we're always told to look in the back of the office and see the week's numbers trading on the wall. There's usually a whiteboard or a blackboard with how it's all going. Just have a little look at that. And you can talk to the people on the ground. You can go and have a coffee and watch and see how many people go in to pick up the footfall, where are the vacancies, who are the good occupiers nearby. So commercial and retail was easy to understand. But over time, those yields clearly were very strong in the mid-noughties. Our buyers have had to move sectors and be comfortable investing in other sectors. Only look at industrial, where rental growth, yield compression over the past 10, 15 years, those returns weren't on offer in retail. So our buyers have become more educated in other sectors, perhaps a bit harder to understand. You know, it's hard to know what someone does in an industrial unit somewhere, as much as you can Google them and look at their numbers. Convenience stores have always been a sort of barometer of pricing in our market. In COVID, all we could do was go to the convenience store for 20 minutes a day. Hugely sought after, generally long leases, probably 15 years from a starting point, some with 10 breaks, often with index-linked review. So you've got that guaranteed growth, usually on a site with parking, depending on the location, old pubs that have been converted, things like that. Those were trading at sub 5% at certain points post-COVID. Pricing has moved out a little bit, but they're still hugely sought after. And the best prices when there's indexation, when there's that guaranteed rental growth. Industrial, I just mentioned, the most popular in our world. We don't see a huge amount because the big box stuff is never coming to auction. What we see, the most popular being little starter units that are, whether they're vacant or let, doesn't really make much difference. Huge amount of owner occupiers to have space for storage or new business or whatever it might be, very popular. Or the multi-let industrial estates, where you can roll your sleeves up, manage it a bit, tickle the rents up 50p here, 50p there, on a square foot basis, and see that growth, and you've got that spread of risk as well. Generally, we're seeing about 7 to 9% on the industrials, clearly outliers at both ends. I don't know if any of you touch offices, but I wouldn't want to be a valuer at the moment, signing my name to a number that I've just put on an office. It's we see them, but not too frequently. They might be part of a bigger thing, but when we get now standalone offices, pricing is all over the place. Predominantly the challenge is being working habits. The business park sort of era, PD changed some of that, but are people still going to these business parks? People can work remotely. Zoom, as we were talking about earlier, and Teams calls and things like that have changed the working dynamic. But I think the biggest pressure, and a lot of funds and institutions are seeing this, is the minimum energy efficiency standards, which obviously the base level came in last year at an E and are only going up. The capital expenditure required to uprate some of these secondary, tertiary offices is going to be more than what that office is worth when it's done. And that's assuming you can find a tenant at the other end to take it. So you're going to have to invest to find occupiers, but there's no guarantee those occupiers are going to be there. What specification do you provide? We're not talking central London, although it has its challenges. This is more regional, secondary offices. So very difficult to price it. There is still a market if it's well let, well located, modern, and meets the standards that are required, particularly going forwards as those tighten up. But offices is a challenge, but as always, you guys are probably quite entrepreneurial, where people see challenges, they also see opportunities. Alternatives we'll touch on in a minute. Anything away from the mainstream, the doctors, the dentists, the vets, the roadside, the healthcare, the fitness. Those have always been popular. Generally long leases, often sale and leaseback, as I mentioned, and commonly underlying residential value to a lot of these things. So we can touch on those a bit later. Portfolios, I mentioned the corporate sellers. William Hill was bought by one of its competitors about 18 months, 2 years ago. They held a huge amount of real estate. We did sale and leasebacks for Ladbrokes about 10 years ago. We sold, that was last year, we sold about 150 lots for them all over the country. And this is money to go into the operating business. Some were in reasonable locations, some were in pretty unglamorous locations, could even be little garages that have been converted into William Hills from what you can see. But a sale and lease back, the people that came out of the woodwork to buy these was extraordinary. And I think it was the opportunity for people to buy commercial property as low as £70,000 for some of these units. And returns on those were probably from 7% up to 10.5%. So a lot of people have got £7,000 down payment for deposit. You're buying William Hill, everyone knows them. They've seen their friends, their family making great returns for commercial real estate. And it was staggering, the amount of people that phoned up. That we had a lot in Glasgow, a lot in Liverpool. So we had some very strong accents phoning up the office from people. And some of them were educated in terms of property. Some of them were complete novices. So it was our role to kind of talk them through the process, make sure they knew what they were doing and the implications of what they were doing. But that was hugely popular, 100% sale rate for William Hill. Tesco have been selling anywhere where there's a residential element in their ownership. So flats sold off on long leases or flats on ASTs. They don't want the management issue of having any form of residential tenancy. So they've been selling those. Last year we did 8, we've done a few more so far this year. Pricing on those, anything 10 years certain, no indexation, from around 6 to 7% is generally what we've been getting for those. Clearly it's slightly less interesting where your flats are sold off because you lose that overall control of the building, any future redevelopment. But Tesco, another one, farm foods have been very popular, generally located more northern towns, more regional towns, and they serve the market very well. We sold one last week or 2 weeks ago in the mid-5s. So huge demand for those because it's convenience, it's a supermarket convenience. It's an important sector, anything that's linked to the food sector. So what have we seen this year? If we go on to the next one, more numbers, but it's more what's underlying it. We've had 2 auctions in February and then 2 weeks yesterday. I think December, we saw a massive uptick in the number of buyers registering and wanting to bid. And February is always a bit of a toe in the water. What's going to happen? Everyone's had an extended break and coming back. And February was encouraging. And then last week, I think, or 2 weeks ago, felt like we'd gone back to a slightly more cautious market. We've done £64 million or so from March now. What you'll notice is the lot size is significantly higher so far this year, the average lot size, than what we saw last year. You're late, Ranjan. Up to 850-ish. That's been driven by some larger lots. So the largest we sold was about 7.5 million, a retail park in Chingford. And that exchanged pre-auction, a lot of people looking around. And that was from someone that bought it, that sold their business. We're seeing a lot of people that have sold businesses, that are sitting on cash, that want to come in and buy commercial property. They sold a business linked to food a few years ago, and they've been buying a lot of commercial real estate. So that was the largest, down to a £6,000 ground rent in London. So again, full spectrum. 14 of the lots were plus 2 million, which drag up those numbers quite a bit. The market is cautious. There are still buyers there, but it's not as deep. There aren't as many for each lot as we've seen probably at the back end of last year. And whether, I was going to say the sun's shining and the days are getting longer, headlines are good about inflation, whether that will then slightly tick over into a bit more confidence, but you only need one buyer. And in our world, we can't choose a buyer. We say that everyone's a first-time buyer once. So we speak direct to people. We don't favour track record or this or that because we can't, because it's going to an auction. And generally our sellers, much like you, will be, that's the best price. Are they good for it? Well, they're signing an unconditional contract. So there's no favouritism from us. So it's only one buyer that you need, and we are getting the lot sold. As I said there, it's not as deep as previously, but we've got another catalogue coming out next Friday. I think stock will still be, the volume of stock will still be suppressed from what we've seen the past 2-3 years, even post-COVID, and that's because of the changing landscape now, which we'll come on to in a little bit. So just a few examples. Shopping centres I mentioned, they've sort of made a welcome return to our world. They tend to dip in and dip out, and when the pricing is at a point where the private buyer can get hold of them, they come in. We've done 8 since October, 26 million. Now, some of these on their own would have traded historically for twice that number. And these have been sold by REITs, by property companies, by privates. And although the gross rent is obviously huge, it's the net operating income. What are you taking home at the end of the day? There's always going to be some form of shortfall, the vacancies, the rates, the service charge liabilities. But the opportunity to get hold of these things, the average price that we've achieved is between 15 to 20% off the net operating income. On a capital value rate, as little as £15 a square foot, up to about early £30 per square foot. So they are vastly reduced from the level that they had been at. Some of these are being sold because they've been made as good as they can. People are actually, some of them, turning a little bit of a profit from when they bought them. Others are, they're taking up too much time. It's a bit too much of a challenge. The upside for us isn't great. We've had so much interest in these because of the yields. On Rochdale, which we sold in December, 165 people downloaded the legal pack, countless viewings, and that was sold prior, way ahead of the guide. Most of the buyers have been savvy, seasoned investors that understand how to operate. It's not messy retail, but it's time-consuming retail. And the mantra is, I'm going to try and bring down management costs. I'm going to try and reduce service charges. I'm going to make occupational cost for tenants as little as possible by removing service charge and things like that. And actually, the privates think they can probably broke deals with tenants that the more corporate entities can't justify. They can have a relationship with the tenants. They can walk in, have a chat, how you're trading. You know, I can bring your rent down £10,000 to them, because even if you bring your rents down 25% and stabilise those cash flows, you're still getting very double-digit yield. So they're not for everyone. They are risky, hence the yields that are achieved. This one, hugely leasehold on the suburbs of Edinburgh. But we've sold four. These are all clearly geographically different cash flow profiles, but the yields are all very, very similar. It's not going to be your first ever purchase of a commercial property, one of these. But when people see the yields, they think, well, how many calls? What's the catch? Why isn't everyone buying this? It's about getting into the detail, getting underneath the net operating incomes. So a lot of people also like the fact that some of these traded at 10 times multiple of what they're being able to buy at. To feel you're buying at a discount from the last person it's a psychological thing that a lot of people take on board. Similarly, when you look at the title registers in the legal packs and it tells you the last price, there's that reluctance to pay more than someone that bought it X number of years ago, months ago. Regardless of knowing exactly what the product was then, there's still a bit of a psychological thing. So some of these are hugely, as I said, discounted from their original numbers. And there was one we sold, I mean, it was a couple of years ago in Coventry, that was traded at 60 million, and we sold it for around 5. So that's the way these things have fallen. They'd lost all the anchor tenants. That's just one example, but the buyer there has boosted the income by about 150%, and it will pay for itself in 4 years or so. So there's great opportunity there. Just moving on to some alternatives. As I mentioned, 4 different options here. These are from March and February, very different lot sizes, but there's a bit of a theme to it. It's the long income. So Stoke Poges, obviously an affluent Berkshire area. This was a gym let to Nuffield Health until 2050. Annual CPI-linked reviews. Now, the covenant has had its challenges. Not everyone likes gyms, is comfortable with gyms, understands gyms, because when you break it back, you think, what's your rent? How many memberships have you got to have just to pay the rent alone, let alone the staff, let alone the servicing, the maintenance and everything else, and the business rates that go with it. But this was on a 4.5-acre site, so you had a lot of surplus land there. Every time we went for a viewing, the car park was rammed. Every single part of the gym was very busy. People don't like having swimming pools because ultimately you've got a building with a hole in the ground. And if that tenant leaves, what are you going to do with it? But it didn't really matter here. We had 12 people pay £50,000 bid of security to register for this one. And the pricing went more than £1 million over where we were. We had bids beforehand in the early 4 millions, which were all turned down. And competition on the trade drove that on. That was sold by a fund manager. And then these 2 down here, sale-and-leasebacks. One's dentists, and rather morbidly, one's a funeral directors. And a veterinary practice up there. The resilience from online trading. None of these things can be done online. Funeral directors are going to be around longer than we are. And this, 10-year break, they've all got long income, recognised covenants. Most of veterinary care is paid by private insurance these days, pet insurance. So there's confidence that people are going to be getting income and paying rents. I mean, I don't have any pets, but I hear enough about it. The insurance that people are paying for their pets is extortionate. So people are comfortable. But also, they're alternative sectors, but they've got long-term alternative use. I mean, these three here look like some form of residential property in the future. A block of flats in Emsworth, perhaps, a pair of semi-detached down there, and maybe a detached property here in Sheffield. So you've got guaranteed income, you've got capital, you've got rental growth here and here, and it's that comfort of the lease length, some rental growth included, but in the future, one would think land values around Stoke Poges will only be heading in one direction by the time you get to 2050. So there's an alternative option there. And otherwise, the price points are very affordable. The yield's sub 6% on those two, and a little bit higher here. It's the underlying alternative use in the future that drives these. We had a portfolio of dentists in September that traded at sub 6%. There were about 12 of them. Most of those looked like houses. They were over time converted into dental practices, long income, but the cost in turning them back is not going to be too significant. So the bricks and mortar value props up the investment value plus a little premium for the income. And then a couple of boring ones. I say boring, different. It's location security. These are to central London that were sold earlier this year, and these are not exciting for the sort of more entrepreneurial people. This is wealth preservation. They all have a little bit of enhancement. You might get some accretion over time of the location. So I don't think yield is really the driver of either of these. This one was holding over since 2020 at 37,000. It's clearly massively under rented. It had an arrangement of letting rooms upstairs. I think there were 7, let at 37,000 on Westbourne Grove. I think the shop alone would command more than that. But the angle here was to reconfigure the upstairs, generate a lot more income, let it separately. And you're buying in at £600 a square foot here. Longer term, there is the ability to create value. It's not going to be income return in the short term. Baker Street, so we're half a mile closer to central London. It's £700 a foot. This one wasn't actually offered. There was a legal issue just before the auction, but it sold afterwards. Had a vacant third floor. People were looking at it from a longer term alternative use angle, but at the same time doesn't have to be. There's always going to be demand for offices. There's always going to be demand for retailers in that sort of location. If you look at the shopping centres at 15 to 20%, these down at sub 5% here and sub 6%, it's a capital value rate per square foot. So yield isn't always the driver in our market. There's often an element of what is the bricks and mortar worth? What premium am I willing to pay on top of that for any income that I'm getting? What can I do in the future? So that's the slow-term, long-term plays. One of the guys in the team would call it widows and orphans. It's the preservation of wealth for future generations. And then if we look ahead to things that are to be considered, clearly the headlines, as I mentioned, on inflation easing, and there's talk, there's going to be rate cuts in the UK, in Europe, and in America. It's when are they going to come, and how many are they going to be this year? Depends on who you talk to. I'm sure Ranjan will have a view about where rates are going and might contradict what anyone was going to say because he's a man that thinks laterally. But it's the borrowing rate as much as the saving rate as much as the borrowing rate that our buyers look to. Because most are cash, if you can put it in a bank, lock it away securely at 5%, what risk premium do you need on top of that to take on commercial property and clearly residential that some of you do? And as the base bank rate comes down, one would think that yields are going to follow suit. Where are they going to settle? Who knows? It's clearly not going to go back to what it was. I was saying earlier, I've never worked in an environment without a Conservative government or without interest rates at sub 1% until 18 months ago. So it's a learning curve for me. It's interesting, it's fun, and suddenly the unavailability of money for some people that seemed to have loads a while ago is quite interesting. But is it a time now to be brave and get in before those yields start hardening? I think that's why I put it at the top there. there are the very traditional, sensible buyers that will have a very long-term view anyway. We've had the cycle of the short-term buyers with low interest rates, and now if rates are going to be coming off, one would think yields will follow, and therefore should you now be looking around, finding that opportunity and being brave and getting in now, because actually if sellers flick their rearview mirror around and start looking forward saying, oh, pricing's going to harden in the future, and buyers start looking backwards, so we've gone completely the other way, then is there going to be a bit of a standoff like we're seeing now, but sellers aren't selling because it's not at the right level, but the reasons that they're not selling now might be it's going to get better. The downside risk, clearly, leases are going to be getting shorter the longer you hold out for yields to come down. So that will impact value as well. The election is a short-term distraction. As I said, our market has been and always will be long-term. So there might be some tax implications when one would assume the Labour government come into power with a sizable majority. There might be some tax tweaks here or there. There might have to be some restructuring of how people hold their assets. But actually, medium to long term, I don't think it's going to make too much of a difference to our market. We'll wait and see, but who knows? So, as I said, for the majority, it's a long-term game. You make your money on the way in, as everyone always says, like when you buy a house. So, is now the time to be buying into the market before we see everything come down a little bit, availability of finance be cheaper. I don't think that they'll up their rates much from 50 to 60%, but there are people more qualified than me to talk on that, where a borrowing rate's going to go. But I think there are a huge amount of people that are now actively looking, thinking, is it now time to get in? And sellers similarly, do I want to release some cash because actually I've got the next idea? So we'll see. In summary, the market is cautious, but it's active. It's private, it's cash, as I said. And where assets are correctly priced, there is a huge amount of demand. For some assets, it's very difficult to determine pricing. Does a 10% change in pricing mean suddenly you're going to be swamped with interest? In some instances, no. It's the product that people don't like rather than the price it's advertised at. But it's an active market. It's an interesting market. It is fascinating who we deal with, particularly on the buying side, and the enjoyment we get from doing what we do. So I think we will continue business as usual. We don't have the peaks and troughs of other markets, but generally speaking, this year I think will be a positive year, but pricing is key. So I think that's probably finishes where we were. Probably talked for longer than I should have done. Well, that clock's still saying 9 o'clock. Has anyone got any questions?
I'll just pass the microphone around if you've got enough questions. But Will, are you shooting off after
I'll
this?
hang around for a little bit.
Okay, fine. So I think if we're going to ask questions for Will, let's do them now because we won't get another chance throughout the day. I've got a couple, but Stuart, do you want to ask yours first?
Thanks for that. Great presentation. Just wanted to touch on two really quick
questions down there.
Just a few notes. It was great to hear about the dentist. It's got a bit of an appetite. We've just secured a dentist on it's inside the Act. He wants a 15-year with a 5-year break. And we're thinking about selling that on, potentially through auction. So it's good to hear that's got a bit of interest. And what's your view on restaurants? So if we were to do it, we've got another commercial site in Windsor, and we're thinking about either doing the whole building or part of the building, securing it, stabilising the asset, and then selling it on. What's the appetite for restaurants?
Headlines are not good about casual dining leisure.
Okay.
But the big challenge with pubs and commonly restaurants is rental levels. Because pubs were historically done on barrelage and output and profits, which you often don't get visibility of as a buyer. So the rent could look extortionate on a capital rate per square foot, on a rate per square foot. But actually, if the profits are through the roof, it's very affordable. So I think if the rent's sensible, if you've got a freehold entire building, very popular. We sold the coat in, did you say Winchester?
It's in Windsor.
Windsor, great location. I actually reported on something else in Windsor very recently, which is in the dining sector. Location is key, and covenant strength is still important. You'd think it's so many tourists in Windsor. How can a restaurant or a coffee shop not make money? But it's amazing how many come and go. We've got another one, leisure in Windsor, coming into our May auction, so it'll be interesting to see. Probably keep your eye out for that one. It's on Pescod Street. But I think they have traditionally had long leases, wasn't that long ago, Pizza Expresses were 35-year leases and the best thing you could buy at 5%. But is it the whole building?
We've got two options. So we've got three offers. One's from Megan's, one's from Pho, a Vietnamese company, and one is from Cornish Bakery. Okay. Two of them want just the ground floor and half the first floor for toilets and this nice light well. And we can keep the front and do two beds and a one bed. Or Megan's potentially want the whole building for a slightly higher, or for another 25 grand a year. So we're just trying to work out what the best option to do.
I think it'd be interesting to get everyone's view here, because it's a classic private investor purchase. Shop leisure with residential upper parts. It seems to be what has always been the sort of traditional auction lot, what everyone wants. It's that spread of risk, it's the ability. Comes with a bit more management, comes with some capital expenditure one way or the other for fit out or for conversion, but it will come down to what covenant you've got on the lease.
Yeah.
I mean, as brands, everyone knows Pho, everyone knows Megan's, everyone knows Cornish Bakery. I think it's what they're offering, what incentives you're going to have to give away, where the breaks are. And I think you've got to look at the end values of what it's going to look like, what you're in for, versus if you've got residential there. Flats in Windsor are difficult to price.
Yeah,
speak to the agents.
Castle, so they're great, but
there's a lot of agents that tell you they're up there. Look at the evidence, and it's there. And it's a trade-off on yield and capital values on residential at the moment, particularly in places like Windsor. But keep your eye on that one we've got on the next one. Interesting, good location.
Cheers.
Just get the picture when they're doing the changing of the guard.
Yeah, exactly. Right up front.
Yeah.
Anyone else? Questions? Yeah.
You mentioned that 50% of your lots sell pre or post auction.
Yeah.
Do you find that a lot of sellers would list their property in auction to sort of force the deal through as a tactic if they've already got a private treaty offer?
Yeah, and it's something that when it becomes more in the buyer's favour as a market, as it has been for a while, things are dragging on a long, long, long time. And sometimes they're properties we've seen before and given a view on that come back round. This person is under offer. They've been under offer for 3 months. I've lost patience. And it commonly does happen where party A is buying it, but they're messing around and putting it in the auction. We'll always agree something with the seller that if they buy it at certain times, we're not going to be charging full fee because we haven't brought this party to the table, but we've offered something to get it done. It happens quite a lot, and the frustration is the legal process is more complicated than it should be, particularly with buyers wanting to slow things down and then chip pricing and everything else that goes with it. So we see it a lot. I think auction is great for the unconditionality of it, but it's having a deadline makes a massive difference. And if people have that threat that they're going to lose out to someone else, or in the meantime, if we get a higher bid, unlucky, you've had 3 months to do it, we'll sell it to someone else. Yeah. So we do see that quite a lot. Does
it happen the other way around as well, where the seller gets egg on his face and actually gets less?
Yeah,
okay.
It does happen. And it's the challenge that we see with that is if the price that they're under offer at is strong, that we think is ahead of where the market will be, if you put it into the catalogue at that price, you're chasing that one person to perform. And if they don't, you've mispriced it to the market that might be here or where we perceive the market to be. So if they don't perform, you probably haven't got anyone else because they might be at a slightly lesser level. And so that's where the challenges come. And if that buyer walks away, you might have wasted 2 weeks of your 3 weeks marketing at what we perceive to be a misprice. So that's the downside of it. So it's how close is that person to actually performing? Is it still all hot air? Are they still waiting for finance? Have they done what they need to do? Because if they're too far out, then we might say, look, they're not there. Because anyone can make an offer on an email without doing anything else. It's finding out the legitimacy of the offers.
Gotcha.
Anyone else? Any other questions?
No? Bored everyone to death.
I've got one for you.
Oh no.
So there's a couple of other commercial auction houses that have tied up with some bridging providers.
Yeah.
I'm sure you'll know who they are. And
possibly comment.
Are there any plans for Allsop to do something similar with low loan to values with pre-agreed valuations?
Yeah.
What are your thoughts on that? I just wondered why you hadn't done that yet.
We, donkeys years ago, before my time, we had a finance offering that was not in-house, but a subsidiary of. And I think the decision was made that at the time, that has served us well, that we want to be entirely independent. We don't want to be seen to be favouring certain providers, because I know that it's cash generative for a lot of people that provide this. We've had discussions very recently with numerous people about this, and there's a slight compliance issue which is being worked through. So I think it will happen. I'm not party to the conversations that are being had, but I know that there are lots of brokers and also lenders that have these tie-ups. We had that we want to be entirely independent stance for a long time, but I think what we know is we've got to help buyers as much as we can, because our duty of care is to our clients to get them the best price. And if there's one person extra that we can get to bid, then that's great. So we spend half our time being solicitors, being counsellors in some instances, being surveyors. So it's navigating as many people to the point of being able to bid. So there have been discussions that have gone on, and it's working out how that best fits our platform, our offering, and we've got to make sure that the brand that we are considering align with how we want to do business.
Yeah, it's difficult.
There isn't a right answer. I suspect we will do it in time, but as I said, I'm not party to who it is with or what discussions have been had. We used to have people advertising the old auction catalogues. We used to have people come with the stands to the auction rooms, but that was kind of when I was down there and not really too kind of involved in that sort of thing. So it will happen, I suspect, but I don't know with whom or when.
Very interesting. And then final one for you. The current way Allsop offer their properties is unique, although lots of other auction houses are using the same. Do you have any plans to change that to live stream? What are the benefits for the current way you're selling property? I don't think you'll return to the room. I know you mentioned that, but realistically, the costs of running a live auction. I mean, Barnard Marcus are currently the only auction house that are doing it
downstairs,
and nobody turns up. Is it 20 odd people in the room? Everyone's online still. So, what are your views on the way it's operating?
We've talked about this since March 2020, and if we had chosen to do what we do, there'd have been uproar, because nothing better than being in a great room, and there'd probably be 500 people throughout the day coming in and out, and you'd have certain crowds standing in certain places every time. You knew who they were, and you could work out that's the tenant of this one, I recognise them, and you could sit there and wait and wait and wait, and their lot comes along and they start twitching, and the ability to meet people, chat, for people to meet each other, is, everyone misses that. Because it was an enforced change, there couldn't be any grumbling, and it was, when do we go back? How do we go back? I think the cost is not so much the driver. I think our residential team went back. I was saying earlier to someone, they went back in May or July last year. The first one was curtailed by train strike, so it got moved. I think it was July. And they were in a hotel in Mayfair. And our fear as a team, so we have separate residential and commercial teams, our fear was that you'd end up with a room of sellers, because people used to come and like to see their lot being offered. People have become so accustomed to bidding remotely. They always could bid online back in the day. What you don't want is a room full of sellers, because it's the standoff between having some interaction versus it being, in essence, this is where it would come back to the cost. It would be not a good deployment of money to have a room full of sellers, or if people are in the room, would they be bidding on their phone because it's more discreet? There was the atmosphere where if, so-and-so's bidding, he knows his stuff, I'll have a go as well. Or Mrs. So-and-so's bidding, she knows everything about this town, people would stimulate themselves to bid. But if actually people are discreetly bidding on their phone in the room, so they have decided they won't be doing that in the short term, they're doing streaming. We are, again, considering how we do it. It's been effective for us, but we've got to make sure we stay on top of things, stay ahead. And also, we've got to bring back some personal touch to what we do. it's great to see people here. Anyone could set up an auction house tomorrow, buy in some technology and sit behind a computer. What we're good at is the knowledge we've got and the skills we have and talking to people and meeting people. So I think that even just having a face on a screen, being able to bid on the phone gives a little bit more of that. So again, we had a meeting on it last week. So things might change.
Excellent.
But it's an ever-evolving world, isn't it?
Amazing. Guys, let's give a massive round of applause for Will.